The U.S. has two primary measures of prices paid by consumers for goods and services. These two consumer price index groups get constructed by separate federal macroeconomic bureaus and behave differently over time. Our chief equity strategist and economist, John Blank, now here to elaborate and hopefully clarify some things in this concept. John, what are the two measures, first of all?
CPI, you hear a lot about the consumer price inflation. It's put together by the Bureau of Labor Statistics because it's really used to set up a cost of living adjustment annually for consumers who have living on Social Security. So it was designed for all urban consumers, and that is where it picks its prices up from people who are looking at prices as an urban consumer. So that is actually a subset of the U.S. economy. That needs to be understood. So it actually ends up being typically higher. Right now it's around 8%. But what the Fed cares about is the economy, not the urban consumer. Obviously, the urban consumer is the major part of the U.S. economy. They track one another. They're very consistent. But they are different, and it's always the case that the personal consumption expenditure, PCE, is lower. And it contains all consumers and all nonprofits, which sounds like, oh, that's, Salvation Army. That's not the Salvation Army. That's state and local government and federal government, all trade and everything else that's going on in the economy in investment. So this is a broader number. It goes down less, it goes up less, and it's usually lower. So this is what the Fed likes. It's the economy number. When they're managing an economy, you want the economy prices, and that's the PCE.
And is what you've explained basically how these two measures differ from each other?
Terry, I wrote a piece, Deep Dive in Inflation. That's the core thing that standard people need to understand is that government agencies get different mandates and they study different things. And so it's not a conflicting mandate. It's just saying, hey, I'm the Bureau of Labor Statistics. I'm in charge of payrolls and Social Security is on your payroll check. So the labor statistics have their own CPI. And then if I'm the Bureau of Economic Analysis, I'm in charge of the economy. So the Fed cares about that, and I have my own prices for that. So that's a basic thing. Inside of that, there's plenty of other index construction measures and other related things you've got to read about. It's just a lot of nerdy stuff that you have to understand.
Yeah, basically, as I understand it, there are four categories or effects that summarize these two measures that you've talked about. Is that right?
Yeah, that's basically it. And you can go through them online. It's not something we should talk about in a thing like this. It's just more technical stuff. But the basic point is the CPI will be higher. It'll move around more. The PCE is lower. It moves around less.
And are these two measures forward or backward looking data points?
They are contemporaneous. They're coming out, from their agencies, and they mark the economy in time as it is. And I remind people all the time, your job to get better is not to, have some kind of great forward look, but just to clear your attic out of your mind and put the most present data in. If you do that, that's actually the job you need to do.
And what's the bottom line now to this deep dive into consumer price inflation?
Well, the deep dive is, we're in October, and it's a year-on-year measure. And the latest data that came out of the PCE, because we get the Q3 GDP, which the Fed cares about, was actually something in the fours. And that's why the 10-year Treasury fell down below 4%, because if it's true that the PCE measure, we don't know the revised data, that's really what matters. We don't know the fourth quarter data because we're in it. But if it's true, if it keeps holding up, then the Fed doesn't have to hike as much. And that's kind of the news that perhaps on a year-on-year point of view, somewhere in the spring, we're going to roll into 3.5%, 4% CPIs, and that would be very welcome.
And what about the index of leading economic indicators? How does that factor into this picture? Some say it's a low-key recession signal.
That's correct. But, this gets back to calling things in advance of seeing things. And, again, as a person out in the world, you're, trying to be the superstar is going to cause you more problems than it's going to be a solution. So I would just acknowledge that, but ignore it and spend a time on my understanding of the basic core, what's called contemporaneous, immediately going on now type indicators, things like the LEIs. They're interesting, but they can change, and then they do, and then the story changes.
Will all of this data give the Fed maybe a reason to ease up on its tightening?
We'll see in the spring. I would think if the data holds up through the spring, yes. If it doesn't, no. The Fed is going to hike, here in the next meeting on the 1st of November. Then we've got another one in December, and this December meeting where the present day will start getting a much more serious look.
Has this data caused you to change your outlook for, say, GDP, the labor or housing markets going into the end of the year?
No, it isn't. I had a 2.5% Q3 GDP growth rate. It came out at 2.6 today. Is exactly what I expected. And I do expect it to come down a little bit to the ones here in the fourth quarter on a year-on-year basis, just because the comps are really, I just think we topped out of COVID last year. I think a lot of what you're seeing when you're seeing year-on-year data out of a COVID pandemic is, you were at a high level because of all the support the government threw at it, the economy, and now we're just going sideways off those year-on-year numbers. So it gets more interesting in the spring on a year-on-year basis. It's really just kind of how math works.
Okay, you wrote recently that foreign stocks have been completely written off this year, yet you have your eye on three of them: Banco do Brasil, Merck, and Ecopetrol.
All right, so I've got Banco do Brasil at $7 a share, Terry. I mean, this is just an insanely low price, to your point that I talked about. It's actually been rallying for the last year. It used to be down at 5. So if you get an election behind you, Banco do Brasil is a way to play, some of the lower uncertainty in Brazil. And, you got a low price on a stock. And if you like low price stocks, you want to look into that one.
And Merck, ticker MKGAF, German company, right?
Yeah, Merck is a German drug and biotech company. This is a much pricier stock at $170 a share. And it's got a really poor chart off the highs. It was well over 250 back in January. Now, why do you like this? Because, of course, we all understand this is the war in Ukraine and that kind of thing. So you got to buy stuff when there's hair on it. So if you think the war goes right next year and the German stocks get a bid, then you buy Merck. It's a real nice play on the DAX and the Germany.
And Ecopetrol, ticker EC.
This is an interesting one. More interesting, actually, than these other two. This is Colombia's oil producer. Again, you say Colombia. Why would I buy Colombia? Well, it was at $20 a share not too long ago. It's now 9.5. Thing moves around a lot because it's down in an emerging market with all these worries about emerging markets, particularly the currency worries and everything else. But if you believe the United States needs oil and gas, and those prices are going to stay high, then it's going to come from a place like Colombia, and you got to like EC.
Okay, our chief equity strategist and economist, John Blank, with a bit of a deep dive into U.S. economic data. With John, I'm Terry Ruffalo. Check out this just-released special report, by the way, 5 stocks set to double, where 4 Zacks experts each announce their single favorite pick with the potential to gain 100% or more in the months ahead. Get more details on that at Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.